Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, June 2, 2026. We're Elena and Marcus.
And today we are taking a deep dive into our daily desk data to unpack what is frankly a bizarre contradiction in the market.
Right, we have a stock market pricing in this flawless, AI-driven digital utopia, just crashing headfirst into a bond market that is screaming about 1970s-style physical inflation.
It's the tension between the limitless digital world and, well, the physical constraints of things like copper. You are about to see what happens when the digital boom runs out of runway.
Moving to today's data, there are three critical themes you really need to navigate this environment. First, there is a massive upside surprise in U.S. labor data, which is forcing a repricing in the rates market.
A very aggressive repricing, yeah.
Second, we are seeing a historic, bifurcated day in equities. It is defined by a hardware supercycle and a staggering capital raise by Alphabet. And third, the physical constraints of this digital boom are showing up in multi-year highs for copper, all set against a highly volatile backdrop in global energy.
To understand why these narratives are colliding, you really have to start with the foundational cost of capital that underpins everything.
Correct. Looking at our latest run of economic data, the April JOLTS report is the focal point.
And for those tracking the broader economy, JOLTS measures job openings, not just who actually got hired. It measures the corporate appetite to hire.
The numbers today were huge. Job openings came in at 7,618,000.
Which shattered the 6,866,000 consensus.
Right, a massive unexpected surge in demand. And layoffs also dropped sharply to 1,692,000.
Which, sounds like a positive indicator if you were just looking at the headline.
But if you are trying to get a mortgage or secure a business loan right now, this is actually the last thing you want to hear.
Indeed. The immediate reaction in the Treasury market was decisive. Yields reverts their early morning rally, the absolute second that labor data hit the tape.
Right now, the two-year yield sits right around 4.045%, while the 10-year yield is trading at 4.445%.
With the 10-year, 2-year spread remaining positively sloped at plus 40.6 basis points.
So I want to pause here. Can you give a simple first principles explanation of this yield curve reaction for our listeners?
Sure.
Think of it like a leash tied directly to the Fed's immediate policy rate versus the leeway the market gives the broader economy over a full decade. Why does a hot jobs report mean the Fed's hands are tied, keeping borrowing costs high for regular consumers?
That leash analogy is perfect for the front end of the curve. Because the 2-year yield is so tightly tethered like a leash to what the Fed does in the next few months, a massive beat in job openings signals that corporate demand for labor is simply unyielding.
So they cannot cut rates.
Correct. The Fed cannot responsibly cut interest rates when the labor market is this tight. Cutting rates stimulates borrowing and spending, which would only drive inflation higher, so the Fed holds the leash tight.
Which keeps the 2-year yield elevated, which means the leeway the 10-year yield has to adjust to a world where those short-term borrowing costs remain high for everyday consumers.
Exactly. Auto loans, credit cards, revolving corporate credit, all of it stays expensive because the bond market is digesting the reality that employers are actively hoarding labor.
Which keeps wage pressure high. And looking at our proprietary updates today, Fed pricing for a June rate cut is completely dead.
Dead. Market odds of a rate hike are actually now simmering for 2027.
On that point, that hawkish shift is heavily supported by commentary crossing our desks today. The Cleveland Fed's hammock explicitly cited 3.8% PCE inflation as a catalyst that would warrant actual rate hikes.
And keep in mind, PCE, personal consumption expenditures, is the Fed's preferred inflation gauge. Seeing an official cite a 3.8% target there is a very aggressive stance.
And it is not just a domestic issue, right? The international context we are trapping is equally restrictive.
Yep.
The Bank of England's Green echoed hawkish sentiments regarding inflation and the ongoing conflict involving Iran.
While simultaneously, we have to monitor the Japanese yen, which is inching dangerously close to the 160 level against the dollar.
Which elevates the risk of direct currency intervention.
Indeed. It adds an entirely new layer of volatility to global capital flows.
Understood. If borrowing costs are staying elevated, that brings us to how corporations are funding their growth. Normally, high interest rates choke off risk assets.
Because companies have a harder time borrowing money to expand.
Yet equities are completely ignoring the bond market. The S&P 500 closed at 7,609.78, marking its 9th consecutive all-time high.
But there's a major catch in today's data deck.
Right. The equal weight index was completely flat.
That equal weight metric is crucial. It means the rally is incredibly narrow. A tiny handful of mega cap stocks are dragging the entire market upward, masking weakness in the vast majority of businesses.
And what is dragging it up is a pronounced hardware supercycle. The single stock moves in our data deck highlight this perfectly. Marvell Technology, ticker MRVL, surged 32.5% today.
Directly catalyzed by NVIDIA's CEO dubbing them the next trillion-dollar company over at Computex Taipei.
Hewlett-Packard Enterprise, ticker HPE, also jumped 19.5% on AI server demand. The broader SOX index gained 5.9%.
But that capital, it has to come from somewhere. Institutional consensus clearly notes a rotation out of software to fund it,
The IGV software ECF dropped 310 basis points today.
reversing a recent rally. The market is aggressively discerning between physical AI infrastructure and software companies that might face delayed monetization.
So hardware stocks are soaring, but building that infrastructure is not cheap. Alphabet, ticker GOOG, fell 3.8% today after announcing an unprecedented $80 billion equity raise.
Our daily desk data breaks this down into a $30 billion public offering, a $40 billion at-the-market program, and $10 billion from Berkshire Hathaway.
I want to push back on the market's reaction here.
Right.
Think of this massive equity issuance like a highly successful local business, say, a bakery aggressively issuing new shares to build a massive new factory.
Right, the Berkshire anchor provides a stamp of approval that the strategy is sound.
Exactly. But the immediate dilution makes existing shareholders nervous about the sheer scale of the capital expenditures required to compete in AI.
Understood. Even when a local business builds a new factory, the current owners own a smaller percentage of the total profits until that factory actually generates cash flow.
Their slice of the pie gets smaller.
Correct. Investors are weighing that immediate reduction in ownership against a very uncertain timeline for AI monetization.
Moving to today's data on the broader financial sector, exchange operators like CBOE, CME, and NDAQ dropped between 3% and 8%.
As dealer desks actively digest the business model risks of perpetual futures, these instruments are pulling massive trading volume away from legacy exchanges because they're vastly more capital efficient.
It is a structural disruption to their core revenue. On that point, bridging the gap between digital ambition and physical constraint brings us to our commodities data.
Because building the infrastructure for Alphabet and Marvell requires hard assets.
You cannot code a data center into existence. Copper touched over $14,000 per ton today, up 1.63%, hitting a 4-year high.
Driven directly by the immense power and cooling requirements of AI data centers. You cannot build out gigawatt-scale computing facilities without thousands of tons of industrial metals, compounded by global tariff risks.
There's a distinct irony in this market behavior. Equities are cheering AI software developments as if the sky is the limit, but the real bottleneck might be physical.
Indeed.
The digital revolution is fundamentally constrained by industrial-era commodities like copper and electricity.
And those processes are inherently tied to traditional energy markets. WTI crude closed at $93.44 and Brent at $95.89. Prices cooled slightly off Monday's spike.
Due to political optimism regarding a potential U.S.-Iran interim deal.
But late-session desk data showed the U.S. military fired a missile at a tanker, violating the blockade.
Proving the region remains highly volatile. It is a stark reminder that the energy required for these decade-long AI buildouts relies on shipping lanes that can be disrupted in an afternoon.
Correct, which would feed an inflationary shock right back into the rates market.
Moving to today's data synthesis, we need to connect these dots across asset classes to define the current economic regime.
The broader market is currently resting in an unstable equilibrium.
Right. Equities are pricing in a flawless soft landing and an AI productivity miracle. Conversely, the rates market, driven by jolts and sticky inflation, is rejecting the soft landing, maintaining a higher-for-longer stance.
And commodities highlight the fragility. Energy is a geopolitical wildcard, while industrial metals price in massive infrastructural strain.
Which brings us to a final provocative thought. We must look at the emerging political backlash against AI as the ultimate unseen friction. Our impartial desk data is tracking Bernie Sanders' proposal to transfer 50% of major AI firms' equity to a sovereign wealth fund.
A massive shift in the narrative.
And we are seeing local political revolts. In Festus, Missouri, and in Virginia, city council members were removed over multi-billion-dollar data center approvals.
Because citizens are pushing back against the immense strain on local power grids and water supplies.
It leaves you pondering. If AI works perfectly, Will the ultimate ceiling be technological capability or local and federal political resistance over resource distribution and power consumption?
Indeed. The intersection of capital expenditure, physical limits, and political will is the frontier for this market.
To briefly recap today's core takeaways, robust labor is stalling rate cuts, narrow AI hardware strength is masking broader equity weakness amid massive capital raises, and commodities are signaling physical constraints. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.